Hi friends, my name is Krishna. Welcome back to my YouTube channel. We already discussed about historical cost methods, and we also got into non-historical cost methods. Out of non-historical cost methods, we discussed about adjusted selling price method, and we are yet to discuss on standard cost method. Okay. In this video, we are going to work on some more illustrations. Standard cost method is not a big method that I will cover in the last. Let us work on some illustrations now, and we can go ahead with standard cost method in the later. Okay, right. Without wasting much time, let us get into the illustration. Okay, guys, let us discuss about the illustration 8 now. From the following particulars, ascertain the value of inventories as on 31st March 2020. This date is very important. 31st March 2020. This date is very important. Inventory as on 1/4/2019, 1,42,500. Purchases 7,62,500. Manufacturing expenses 1,50,000. Selling expenses 60,500. Administrative expenses 30,000. Financial charges 21,500. And sales 12,45,000. So from here, we are expected to calculate the closing inventory valuation. Okay. At the time of valuing inventory, as on 31st March 2019, these dates are very important, guys. As on 31st March 2019, a sum of 17,500 was written off on a particular item, which was originally purchased for 50,000 and was sold during the year for 45,000. Very important point. In 2019, there was an item written off for 17,500. 2019, I'm talking. There was an item written off for 17,500. When they write off 17,500, we need to see what should be the original price of this item. Original price of this item is 50,000. Original price of this item is 50,000. In books of accounts, they have written off this. It doesn't mean that inventory is not there in the books. Physical inventory is not there. Physical inventory is there, but that inventory, that particular item was written off in the books for 17,500. But what was the original value of purchase? 50,000. Now what happened? This, whatever written off in the books for 17,500, that item has been sold in 2020. That item has been sold in 2020. For how much? 45,000. This amount was written off in 2019, and original value of the item is 50,000. And 2020, this item was sold for 45,000. Why this confusion? Next line, if you read, you will understand why this story has been explained in the problem. Okay, let us understand. Barring the transaction relating to this item, the gross profit earned during the year was 20% on the sales. Except barring this transaction, in the sense, without considering this transaction, their gross profit margin is 20%. Getting my point? That means what? This is an abnormal item. This profit is not equal to 20%. This profit is an abnormal item. So excluding this item, their regular gross profit is 20%. That is what they are giving. Then what we are supposed to do now? See, opening inventory was given as 1,42,500. Are you getting my point? After writing off this 17,500. But 17,500 has been written off. But what was the original value of that? 50,000. So that means 50,000 minus 17,500. 32,500 rupees worth of inventory value is already included here in this opening inventory. Important point. See, this 1,42,500, what we did in 2019, they have written off with 17,500. But what was the original value of it? Original value of it, that item is 50,000. So in this 50,000 worth of inventory is still there in this. Physical inventory is there. But how much has been written off? They have written off only 17,500. What about the balance amount? 50,000 minus 17,500, that is already included here. Now, that 32,500 we need to deduct from here. Why we need to deduct this from here? Because barring this transaction, their gross profit margin is 20%, they are saying. So if they are saying that barring this transaction, their gross profit margin is 20%, you need to reduce that cost, 32,500. So what they did here, see the solution. Statement of inventory in trade as of 31st March 2020. They took 1,42,500 as inventory on 1st April 2019. And what they did, they took 50,000 as the original value. And what is the already amount written of 17,500 they have removed, and 32,500 they have reduced from the cost of inventory. Why they removed this 32,500 from the cost of inventory? Barring this transaction, their gross profit margin is 20%, they are saying. So if that is the case, this amount should not be included here. That is the reason why we are reducing this 32,500. Getting my point? So once we do that, we get 1,10,000. Then cost, we need to calculate the total inventory cost, right? So we need to take purchase into account. Purchases is 7,62,500. Manufacturing expenses 1,50,000 we have to take into account, and total it is 10,22,500. What about selling expenses? What about administrative expenses? What about financial charges? These are all indirect overheads, indirect expenses. They are not direct expenses. So gross margin, gross profit will be calculated on sales minus purchases and direct expenses, right? Sales, sorry, how do they calculate? Sales plus closing inventory minus opening inventory minus purchases minus direct expenses. So with this, they will calculate the gross margin. That is how we prepare the trading and profit and loss account. So sales plus closing inventory minus opening inventory minus purchases minus direct expenses. Direct expenses are manufacturing expenses. So when we remove all these things, whatever you get, that will be your gross margin. So what we need to do here is we have to add only manufacturing expenses. We should not take selling expenses. We should not take administrative expenses. We should not take financial expenses because they are indirect expenses. Getting my point? So we have added this 1,50,000. So the total cost has become how much? 1,10,000 plus 7,62,500 plus 1,50,000 put together. The total cost of the material is 10,22,500. I hope you are clear so far. Then we need to calculate the cost of goods sold. How do we get to know the cost of goods sold? Sales they have given, but they have not given cost of those goods sold. So what we need to do is we need to take 12,45,000 as sales, and out of which 45,000 abnormal inventory is also included here in this. So we need to deduct it because here we have removed the cost. Here we have to remove the sales as well. So this abnormal goods, whatever to the extent of 32,500, which has a original value of 50,000, has been sold out during the year for 45,000. That is what they said here, right? That also to be removed. So 12 lakhs 45,000 minus 45,000 is equal to 12 lakhs. In this 12 lakhs, what is the gross margin? They said 20%. So 12 lakhs into 20%, it is 2,45,000, 2,40,000. So 12 lakhs minus 2,40,000 is equal to 9,60,000. So total cost is 10,22,500 minus cost of goods sold 9,60,000. You get to see the closing inventory value is 62,500 as on 31st March 2020. That's all. That's about this illustration. It's a very small video. I hope you are clear about this problem. If you have any questions, please feel free to comment on my video. I'll try to answer your questions. Right? Thank you so much.